Good morning. Is it in sync with the economy? And if you look at this graph from another paper of mine, where I studied the Great Moderation, you can see that the Great Moderation was so moderate, there was great stability in unemployment, GDP, precisely because financial markets were so unstable and were expanding. You see that credit creation was in line with economic growth, was moving up and down with economic growth until the mid-80s, and then started to develop a dynamic of its own, which is a very bad sign. When you do a Grange causality analysis, you see that in the first period, the economy, GDP growth, is a causal factor for credit extension. In the second period, it's the other way around. Finance starts driving the economy. It's what we call financialization. And remember the other graph, that's with rising levels of debt. If you don't have stability in your credit system, if you have too much credit, what will happen? I think that's an important question, and we can attempt to answer the question, what is a socially useful credit system, by looking at the pathologies, right? Tolstoy said that happy families are all happy in the same way, which is quite boring, and we see a well-functioning credit system doing roughly the same things in very different times and places. 18th century Scotland, 19th century Germany, 20th century miracle economies in East Asia, Korea, for instance. You see the bulk of credit going to the real sector and supporting fixed capital formation, innovation, technological progress, and very little credit going to mortgages and to financial market development, to boost the stock and the level of prices of financial assets and instruments. That has been always a very modest role in credit systems which supported high economic growth. China also, until recently. But Tolstoy also said that unhappy families are each unhappy in their own interesting way. That's how you get the most interesting literature, also how you get the most interesting analysis. So I'll briefly talk you through a number of pathologies that you get when your financial sector is sending too much credit to the property and financial asset markets, and therefore the net debt buildup, the systemic leverage of the economy grows. The first is instability. This was from a paper by Joe Stiglitz in 2000 and others. Shows again that at about 100% of credit to the private sector relative to GDP, you have minimal volatility. So too much credit means more volatility in the economy, which is logical because every financial crisis is an asset market crisis. So the more credit you send to asset markets, and the higher the debt build-up against assets, the higher asset prices go, the lower they can fall, the greater your probability of a crisis, of a finance-induced episode of volatility in your economy, right? The second is inequality. This is a graph that I made for the US economy again. The blue line is the income of the top 5% relative to the bottom 20%, and the red line is the same line I just showed you, credit to going to asset markets. Note that they move together, which again is logical because as credit systems, financial systems become more and more non-bank financial asset systems, property systems, they come to resemble more and more a Ponzi scheme, where you need new loans to service existing loans. That's the definition of a Ponzi scheme. That's exactly what you need in asset markets, property markets with rising prices. And a Ponzi system is a pyramid game which sucks money flows from a very large base to the top. Inequality, of course, right? So there's no mystery about why highly financialized economies are very unequal economies and why we have increasing inequality.